is Jason Gentile, and I'm a certified financial planner and the senior financial advisor here at Apella and at Symmetry Partners. I've actually been with the firms for about 10 years now and have the pleasure of working with many of you for the entire time I've been here. I do see some new people on today's webinar, so for those that are new to this, Apella Academy is really designed to be an educational resource for our clients. It's a new way to share ideas and educate people on specific financial topics. Now, unfortunately, our country suffers from an incredible lack of financial literacy. I mean, kindergarten through 8th grade, high school, and even college for some. Most people have very little to no exposure in the areas of financial literacy. There's millions of baby boomers approaching retirement, and nobody ever really showed them how to invest, how to build their retirement nest egg. And unfortunately, these retirement plans, 401ks, have suffered. So we want our clients to be the most informed people in the world, because an informed client, someone who knows what they own, why they own it, is much more likely to stick with the plan and to reach their financial goals. So Apella Academy, hopefully, is a valuable step in educating people on areas of finance that they may have not otherwise had any exposure to. So let's go ahead and jump into today's presentation, the 5 biggest IRA mistakes. So what we're going to talk about today, and I think it's important really with mistake number 1 to set the stage, right? We want everybody to understand what an IRA is, what a Roth IRA is, how they operate, and kind of the benefits of both. We'll talk about rollover mistakes in the second section, as well as non-spousal and spousal beneficiary mistakes, and that'll concentrate more on the inherited IRA accounts. Beneficiary form mistakes, which is an easily avoidable error that a lot of people do make to this day. And that last one, RMD, stands for Required Minimum Distribution. As many of you know, at age 70 and a half, the government mandates that you begin taking out a portion of your IRA over the course of the remainder of your lifetime. And we're going to talk about aggregation mistakes for people with multiple accounts in retirement. So let's really jump right into it here. An IRA is nothing more than, it stands for an individual retirement account. Now, for many people, these are established as a rollover of money from an employer-sponsored plan, but they don't have to be. Many people open IRAs as a way to save additional money over and above what their company plan offers. You can make additional annual contributions in the amount of $5,500, and those dollars, along with anything that's already in it, whether it's from your contributions or things that have been rolled over from other types of accounts, will grow tax deferred. And that simply means you're not going to pay taxes on the gains, the dividends, or even the interest as they occur within that account. Now, this is very different than a normal brokerage or taxable account where if you were to buy or sell a stock and a gain occurs, you will owe a capital gains tax on that. If you own a mutual fund or a bond and it pays dividends or interest, that will be taxable as income to you. Within the confines of an IRA account, those things are deferred until, once again, the government mandates that you take money out in retirement post age 70 and a half. Now, one of the things we hear a lot is, well, I make too much money to contribute to an IRA, and that's actually not accurate. Most people, as long as they're working, earning a salary, and are under the age of 70 and a half, can actually make contributions to an IRA. Where the confusion really comes in is in the tax deductibility of that contribution. So, you know, the IRS has these deduction limits, right? So if you're single or a head of household and you make $61,000 or less, your modified adjusted gross income, you can make a fully deductible contribution to an IRA, meaning that contribution will help to lower your taxable income. If you're married and filing jointly and make less than $98,000, you can make a fully deductible contribution to your IRA or your spouse's IRA, which will help to reduce taxable income. So really, when you think about it, even if you make more than that, a significant amount more than that, you know, Bill Gates is a great example. He obviously makes more than $98,000 a year, but he is still eligible to make a contribution to that IRA. He is not eligible to deduct that from his income because he makes too much money. So as you file your taxes every year, if you do make a non-deductible contribution to an IRA, make sure that you tell your CPA that you're doing it. It might actually be his or her instructions to you to do it, but you're going to want to note that because that money is being made with after-tax money. So there's a different methodology as you begin to distribute those dollars because you've already paid taxes on them. So it's important that you track. So just once again, remember that it's anybody can make a contribution as long as they're working and under age 70 and a half, right? You have to have earned income. But it's the tax deductibility that really adds to the confusion of an IRA. Now, a lot of people like to make an annual contribution to their IRA, and we like to set up reminders for people to make sure that they get them in before the deadline. That deadline is actually April 15th of the tax filing year. So, for example, this year, April 2015, you had up until April 15th to make a contribution for the previous year. If you're lucky enough to be over the age of 50, you can actually put an extra $1,000 into your IRA contribution, right? So that $5,500 turns into $6,500. Now, one of the things that happens a lot is people will say, well, I'd like to make a contribution to my IRA, but they don't note that it's for the previous tax year. What we always recommend to people if they're making that contribution prior to April 15th or even after, whenever you make it, put in the memo section that it's a previous year or a current year contribution. We'll obviously scan those checks in so that we can track them if you're ever audited, but it helps us and the custodian note the account properly for what year the contribution has been made in. So that little memo section is often overlooked on a check, but here with contributions to an IRA, it can be pretty important. So, once again, just kind of to backtrack, let us know if you're interested in setting up an auto reminder to make those contributions, because if April 16th rolls around and you didn't do it, it's unfortunately too late for the previous year. So we're happy to help with that. We've got a lot of people who rely on us for those automatic contribution reminders. So let us know if we can be any of assistance there. Now, we talked about contributions to the IRA. But what about distributions to a traditional IRA? Well, it's your money and you can take it when you want it, but you need to be aware of a couple of things, right? And there's a couple of ages that really are good guidelines here. So if you're going to take money out of your IRA prior to age 59 and a half, you need to be aware that not only will you pay income tax on that, right, as a taxable distribution, but there'll be an additional 10% penalty on that for taking money out prior to the age 59 and a half. Now, there's a couple of exceptions there. You see them on your screen. Things like first-time home purchase or qualified educational expenses. Those will exempt you from that 10% penalty, but they will not exempt you from the taxation of the distribution. So just keep that in mind because I think that's an additional point of confusion there. At the age of 70 and a half, we've already talked about this a little bit here. The government will mandate that you take distributions out of your account. We'll talk about that in a little greater detail later on. But anything after the age of 59, you are eligible to take out at any time without penalty. And even if you don't want to, unfortunately, once 70 and a half rolls around, you will be forced to at least take some portion of your IRA out. It doesn't necessarily mean that you have to spend it. The government just wants that transaction of you removing it from your IRA so that it becomes a taxable distribution and they can get their tax revenue. Now, a Roth IRA is a different type of IRA with some significant differences and some big advantages over a traditional IRA. Essentially, a Roth is established with after-tax money, meaning that it's not eligible to reduce your taxable income. So this is different, right? This is all money going in post-tax, whereas if you make less than the AGI limits on a traditional IRA, it can reduce your taxable income. A Roth cannot do that. So we'll talk about the income limitations on who's eligible to make a contribution to a Roth in a second, but I just wanted to kind of touch base on a few other important things about a Roth IRA. Now, a Roth, your money will grow tax deferred just like it does in a traditional IRA, meaning that dividends, interest, buys and sells, any gains in the account are not taxable until you begin to distribute assets in the future. That's how it works for a traditional IRA. The additional benefit of a Roth IRA is that distributions in the future are actually tax-free. So if you keep your money in that Roth IRA, for 5 years and you're older than 59 and a half, that money will grow tax-deferred and it actually can come out of the account tax-free. Remember, traditional IRA distributions are treated as income. These actually come out tax-free, so that's a really big advantage. The other big advantage of a Roth is that there's no requirements to take money out at age 70 and a half. So because there's no tax revenue coming out of that, the government actually doesn't really care if you take the distributions out like it does with a traditional IRA. So just be aware that a Roth IRA will have tax-free distributions and potentially no required minimum distributions. Now, there's a lot of positive things that were just said there, right? So there must be a but coming because it does seem pretty great. Well, we did touch on eligibility limits, right? So who can actually contribute to a Roth IRA? So if you're single or head of household, you must earn less than $114,000 to be able to fully contribute to a Roth IRA. If you are married filing jointly, you must make less than $181,000 to fully contribute to an IRA. So if you make more than both of those, well, unfortunately, you won't be able to contribute to a Roth IRA. But as I stated earlier, you would be able to make a non-deductible contribution to a traditional IRA. So we can talk about which one is best for you because one of the common questions we get is that, should I use a Roth or should I use a traditional? And the answer is obviously pretty complex and pretty personal. Now, a couple of basic guidelines, I guess, and these are certainly not rules that you should follow, but a couple of basic guidelines. In general, if you think you'll be in a lower tax bracket later in life, which many people do, you might want the deduction now. So a traditional IRA might make sense for you. If you think you'll be in a higher tax bracket later, right? Well, maybe a Roth makes sense. Remember, you're going to have tax-free distributions from there. If you don't think you're actually going to need any money out of your IRA once you're over 70 and a half, if you don't think you'll need any money out of your IRA after age 70 and a half, well, maybe a Roth makes sense then too, right? Because in a traditional IRA, you'll be forced to take money out. So it really boils down to, one word, and it's flexibility, right? So you can hedge your bet and obviously use both types of accounts depending on your circumstance and the uncertainty of your future. Now, remember, the contribution limit is $5,500 across both types of accounts. So you can't put $5,500 into a traditional and $5,500 into a Roth. It's one or the other, or up to $5,500 across both of them. It's not each. Now, the other thing that's pretty interesting over the past few years for high income earners, for people who make too much money to contribute to a Roth IRA, a lot of employers are now offering Roth 401k options, and those do not have income limitations. So if your employer has recently adopted a Roth option in their 401k plan and you think, well, I make too much money to contribute to that, that's not the case. Remember, those contribution limits apply to IRAs, not 401ks. So you actually might still have an option of putting money into a Roth. Talk to us. We can analyze which type of account is best suited for you if you're eligible to make a Roth contribution, and how that would pay off for you in the future. Obviously, there's a lot of uncertainty about the future, so we can talk to you and strategize on maybe even how to use some additional flexibility in leveraging both types of accounts. Now, just like with anything, you can take money out of a Roth IRA, and similar rules apply from the previous example of a traditional IRA. If you're under the age of 59 and a half, you would be subject to a penalty of 10% for taking money out of the account early. You can avoid those things if you're over 59 and a half or you've kept the money in for 5 years, death or disability, or once again, if you're buying a home for the first time. So there's a couple of ways around Roth penalties as well. And, if you're looking into distribution strategies, maybe you have a Roth, maybe you have a traditional, and you're trying to figure out which one to take money from in the interim, the short term, post 70 and a half, we can certainly help to strategize a distribution strategy for you as well. Now, that was really just kind of setting the table for the next couple of mistakes. So hopefully we have a basic understanding of an IRA versus a Roth IRA, but let's talk about rollover mistakes. And what do I mean by rollover? Well, there's really two common ways that rollovers occur. And unfortunately, I have to throw a little bit of jargon at you, which I don't enjoy. And I know you probably don't either. So there are two different types of rollovers. One is trustee to trustee, and this is a pretty common one. This happens all the time. And the other is what we call a 60-day rollover. And this one is a little more dangerous. It actually can lead to some pretty horrible outcomes, which we'll talk about a little bit greater detail in a moment. So just so you know, we work with a lot of different custodians, and a custodian is the firm who actually holds and custodies your assets, whether it's Trust Company of America or Charles Schwab or TD Ameritrade. Simply a trustee to trustee transfer is one of those firms which we work with and your account is held at, communicating with the other firm, wherever that money is now, and receiving those assets directly, one firm talking to another. A 60-day rollover is you taking some form of possession of the funds directly, right, rather than moving it directly to the custodian and then putting the money back in. So let's actually dive a little bit deeper into each of those. So as I mentioned, a trustee to trustee transfer is unlimited, right? You can do that as many times as you want a year, although it would not make sense to do it probably more than once, maybe twice. And that is once again, the direct company-to-company transfer. Now, for most people, this starts with a direct rollover of their 401k. This is probably one of the most common trustee-to-trustee transfers. In addition to that, you might have a taxable account or an IRA account that you're bringing over to us. You're at Fidelity currently, and you want to move your money with us, which we're opening an account for you at Schwab. These types of Fidelity to Schwab or company-to-company transfers, once again, they're unlimited. So a lot of our clients come to us with assets from another firm, and we handle the movement because we want to avoid all of these costly errors that we're going to talk about. So what we do is we provide you with a transfer form from that applicable company, right? Schwab, for example. We have you sign it. We submit it to the company holding your funds currently. And that form instructs the company where to send the money or where to send the stocks or mutual funds. That's the direct trustee to trustee relationship. Now, for a lot of people, some 401k plans have their own paperwork, right? You've left your employer and all of a sudden you've realized, well, I've got this big bucket of money at my previous employer in their 401k plan. I want to move that over. How do I do that? Well, most of these firms have their own paperwork, and typically you'd request that direct rollover form, and we'd help you complete it. In a lot of cases, we can jump on the phone with you. I know Fidelity is a firm that actually will authorize over-the-phone transfers, and we do plenty of conference calls with our clients to help them move assets over to us in that manner as well. But the key here is get us on the phone with you. Get those forms to us. We will help you properly fill those out. Now, one of the things that usually creates some panic is that a lot of times a 401k plan will send that check for the rollover directly to you. Now, don't panic, right? Because as long as we've instructed the firm how to make that check payable, Charles Schwab for your benefit, for example, you kind of see that on the screen there, you're going to be okay. Now, if that didn't say Charles Schwab, if that just said my name as an IRA, and it's coming from a 401k plan, well, there's a mandatory 20% withholding that company has to do. So I am going to lose 20% of that money from that distribution just because I didn't properly fill out the form correctly, which is why we want to make sure that, in every occurrence, we want to help you through that process. Those forms, unfortunately, are very often cumbersome and filled with jargon that you may have never seen before. And we're fortunate enough here to have a great transfer team that has seen literally thousands and thousands of these things. So I don't want to say we've seen it all because something new pops up all the time, but we've pretty darn near seen it all. Now, the other thing that we talked about was a 60-day rollover, and a 60-day rollover is different, right? That is you taking some form of possession of money. So that might be a distribution from, like I said, that company plan where they made the check payable to you. Well, what do I do with this money now? Or maybe there's maybe you need some short-term cash, right? You have a house closing in a couple of weeks, and your bonus is still 2 weeks away. I have no idea where else I'm going to get money. So you take some money out of your IRA, you get your bonus check 2 weeks later, and you put the money back within that 60-day time frame. No problem. Because you did it within 60 days, took money out, put it back in, you've avoided the taxes, you've avoided the penalties that would have occurred if you waited 61 days or longer. Essentially, it would have become a taxable distribution. Now, here's where it gets tricky, right? You can only do this once per year. And it doesn't matter if you do a second one by mistake or intentionally. Whatever happens after that first one occurs, no matter whether it was your error, my error, it will be treated as a distribution, a taxable distribution, because the rules have changed within the past 12 months. You can only do it once per year. There are no do-overs, unfortunately. So you've done that first example, right? The house closing, and you put the money back in. Now all of a sudden you have a check made payable to you from an IRA, from a 401k rollover that was done incorrectly. Well, sorry, it actually is going to be a taxable distribution now. And as we know, with a lot of these types of transfers, those can be large sums of money that will all be taxable income to you at that point. So it's important. I would just say anytime you're considering doing one of these, ask us first, right? Because we can help guide you through that process. And we have had people, and we do try to discourage it, we have had people who have had to take 60-day rollovers, dip into their IRA and put that money back. But what we do here is, luckily I work with a good team here, so we set a lot of reminders. We have ongoing communication with you to make sure that we get those dollars back into the IRA. Because remember, that 61st day, unfortunately, it is now a taxable distribution, and you owe the government tax revenue, and you will likely, if you're under 59.5, owe them money for that 10% penalty as well. So the next section, and I realize we're chugging right along here. So, like I said earlier, please put your questions in the text box, and I'll answer those at the end. So the next section that we're going to talk about is non-spousal and spousal beneficiary mistakes. So this actually can get a little bit confusing here because there's a lot of moving parts, and this is essentially inheriting money. So what is a non-spousal beneficiary? Well, think of it as your father passed or your uncle passed. Essentially, anybody that's not your spouse who has an IRA passes away and leaves that money to you. This becomes an inherited account. So, I think in most cases we see a spouse typically left as the primary beneficiary, and then the kids or some other relative or friend left as a contingent. So once again, this is anybody who is not your spouse receiving money as an inherited IRA account. Now, there's some things that we need to be aware of when it comes to these. Now, first and foremost, you can never do a 60-day rollover of non-spousal or an inherited IRA account. And why is that? Well, it was never originally your money, right? An inheritance is treated very differently than money that was yours or earned within some type of plan. A trustee-to-trustee transfer is the only type of transfer that works in this instance. So don't take a check made payable to you from your parents' IRA or some type of inherited account. It can be a big mistake. It can be actually a huge and devastating mistake, especially if you think about, my father worked at GE for 30 years and he has $1 million IRA. He passes away. I'm his beneficiary, and I take possession of that cash. I've done some irreparable damage there. So we want to make sure that inheritance, we're just thinking of it in a different light, right? It's not our money, and it has to be treated a little bit differently. Even though it is technically our money, it is originally not our money. So just think of anything with an inherited in front of it as something that has a different set of rules. And, that kind of stands out in the fact that you're not allowed to move inherited funds into your own IRA. It just cannot be done. The name of the deceased must always remain in the name of the title of the account. And you'll see that there in that example, Mary Doe, deceased. And it's an inherited IRA for the benefit of Mary Jones. You also cannot make contributions. I know a lot of people think, well, I've got this IRA here now. Maybe I'll just put that $5,500 that Jason was just saying I can contribute into this account. Well, unfortunately, you're going to need to open an account in your own name, not as an inherited account. You cannot make contributions into an inherited IRA. Additionally, a non-spouse has to start taking beneficiaries in a very different way than they would if it was from a spouse or if it was their own money. You must start taking required minimum distributions in the year following the date of death. This is for IRAs and for Roths. You can't wait till 70 like you might for your own money. Remember, this is inherited money. This is a different set of rules. You miss this distribution date, and there's actually a 50% penalty on the distribution. So I've inherited money from my uncle. My required minimum distribution in this year as an inherited owner is $10,000, but I'm not aware because I think I can wait until I'm 70 and a half, and I'm only 40 right now. So I think I have 30 plus years of not having to deal with this. Well, it turns out I was wrong, and now that $10,000 distribution that I was required to take now has a $5,000 penalty associated with it. So in any amount, a 50% penalty is staggering. But when you think of retirement style accounts, they typically have larger account balances, so the penalties are usually pretty enormous. So it's important that you really stop and think. I've got this inherited money. What do I do with it? When do I have to take distributions from it? That's also an important step that we like to take care of for our clients. With inherited IRAs, we're going to make sure that those people are taking distributions on time. Once again, we have automated this for a lot of you, maybe who are already an inherited account owner, but we make sure that this is an automated process for you, that money is going out a specific time every year. Even if you don't need to take and spend the money, you can take the money and invest it into your own taxable account. So it's important that the money come out because the penalties are huge. And unfortunately, because there's so many differences with an inherited IRA versus a traditional IRA, people get really confused. And this is a pretty big revenue generator for the IRS. As a spouse, it's actually a different set of rules. So if I'm married and I pass away, my wife has a couple of options that she can take, that she can implement. One, she can retitle the account into her own name, meaning that she'll just create an IRA account that says Diana Gentile, and she will take those funds and put them into that. If she already has an existing IRA, she can move that money directly into that IRA. A spouse can also move funds into an inherited IRA, just like we saw for a non-spousal beneficiary. And there's a couple of reasons that somebody might want to do that. So really think of that inherited IRA just think of it as almost just, I'm going to stay as a beneficiary of the account rather than take the money and put it in my name. If you think of a husband and wife, the government treats them as one economic unit. And that's why a spouse and a spouse only can take direct possession and ownership of the IRA of their deceased spouse. So essentially, in that earlier example, I die, my wife takes possession of it, puts that money into her own name or her own existing IRA. She will not have to take any money out of that account until she reaches the age of 70 and a half. The spouse is ultimately, it will always be treated as the owner of that account, right? So much so that they're actually allowed to do 60-day rollovers. Remember, you can't do that in most cases as an inherited owner of an account, but a spouse can. So what's kind of the recommendation then? So if the inheriting spouse is under the age of 59 and a half, we like to recommend that we set up a beneficiary IRA, an inherited IRA, rather than have that spouse take direct possession of the money. The reason for that is they can actually access the cash without penalty. Remember, death is one of those things that avoids the 10% early withdrawal penalty. And if you're under the age of 59 and a half and the money's in your own name, you will be whacked with that 10% distribution penalty in addition to taxes. So remember, as a spouse, you still do not have to take IRA mandatory distributions until the deceased would have been 70 and a half. So you don't even have to worry about that lifetime distribution strategy at this point, right? This really just allows you to create this separate account as an inherited IRA where you're the beneficiary that you can dip into if you need to without having to pay a 10% distribution penalty. You're still not going to be mandated to take required minimum distributions because you were that person's spouse. So this is a different set of rules again. Now, if the surviving spouse is older than 59 and a half, well, it makes sense just to put the money right into your own name or a separate account in your own name if you'd like to keep the money segregated or perhaps have it set up for beneficiaries to, have that money go somewhere else. But if you're older than 59 and a half, you have avoided that 10% early distribution penalty already just by being of that age. So there's no longer a reason to keep it separate as an inherited IRA. So one of the common questions we would get here is, well, I inherited the money at age 50 and now I'm 59 and a half. Well, at that point, you can roll that money directly into your own name. Remember, death at any point is an option for you to move that money into your own name. So because it happened 10 years earlier and you created an inherited IRA account, does not preclude you from eventually moving that money into your own name once that 10% window of penalty is gone based on 59 and a half. So what should you do now? Well, how should you roll over the funds? How should you title the account? When do you want to take money out of the account? These are pretty complex. As we just saw, for two different types of beneficiaries, there's a completely different set of rules. So rely on us for those answers. We'll make sure that your account is open properly, that the assets move over properly, that you're taking distributions on time if you are even mandated to take them. Remember, a spouse might not have to take them for a great amount of years. It's pretty risky to go this on your own just because of all of the different rules, and it's a completely different set for multiple types of accounts. So beneficiary form mistakes. Here's one of the kind of the easiest things to take care of out there. Unfortunately, it's an often overlooked easy thing, as most easy things are, I guess, right? So let's just kind of take some basic definitions. Every beneficiary form has a spot for a primary beneficiary, and this is your top choice, right? For most people, it would be their spouse. And if that person's alive, they will inherit the money once you pass away. The contingent beneficiary is your backup, right? So in most cases, we see that as the man or woman's children. So they're the backup. So if the primary beneficiary is alive, they get the money. If the primary beneficiary is no longer alive, it will go to the contingents. Now, we like to see a primary and we like to see a contingent on every beneficiary form because if there is none, the money is automatically left to the estate, and that means that the probate court gets to dictate who gets the money and how much they get. So you can think of as a beneficiary form as a will substitute, right? It's a legal binding document. That means it's not up to the will. It's not up to the probate court as long as this has been filled out and is on file. It's the easiest way to make sure the money goes to who you want it to go to, not the court. So anytime you start a new job with a retirement plan or open an IRA with a new firm, you've filled them out, but how often do you review them? How often do you even really think about it? Now, it's all these different life events that should trigger, like, I need to do that. So did you get divorced? Did you get remarried? Did you have a kid? Did you lose a spouse or did another loved one pass away that was, maybe a contingent beneficiary? You wanted to leave some money to your brother or sister and they're no longer with us. So it's important that you review these as life events happen, but we like to review them on an annual basis with our clients as well to make sure, because often even what we might perceive as a small life event can have a major impact on how we want to distribute those assets after we're gone. So this actually is one of the more confusing areas too, because it's beneficiary forms can and are often contested based on them not being updated after a life event. So if we go through a couple of quick examples, I have an IRA. I get divorced, and the divorce decree, as my wife and I agree, and the court signs off on it, doesn't entitle my ex-spouse to any of my IRA. Now, I forgot to update my beneficiary form. It still says my ex-wife on there. It's one of those things. It's just a common oversight. So I didn't update that beneficiary form, and then I die. Well, unfortunately, that money is going to my ex-spouse. Why? Well, this actually was a case that was contested all the way up to the Supreme Court. And in the case of an IRA, what's on the beneficiary form rules. So regardless of having a valid divorce decree and legal binding documents that say my wife and I are no longer married and she's gotten what she was going to get and I've kept what I'm going to keep, and I simply just forgot to erase her name and put somebody else's on there, she is still going to get all of that money, not maybe the people who I would want it to. So just think how my potential new wife might feel about that, having that money go to my ex-wife. Now let's look at it if we were kind of thinking about it from a different type of account. Let's look at it as a 401k. Now that same person, right, now divorced, he updates his 401k beneficiary form to give that money to his 3 kids. 2 years later, he gets remarried, but he doesn't update the beneficiary form to include the new wife. He dies. Well, in this case, ERISA, which is the government body overseeing retirement plans, says that despite what's on the form, right, that person, myself, has listed my 3 kids as the beneficiary. Despite what's on that form, a spouse cannot be excluded without prior authorization, right? My spouse would have need to sign off on my beneficiary form saying, I realize I'm not getting anything and I'm okay with it. That didn't happen. I thought I did the right thing. I updated my beneficiary form to include my kids, but I got remarried. I didn't put my new wife on it, and I passed. So in this case, ERISA says, no, you cannot exclude the wife. The wife is now the primary beneficiary despite having the kids on it. And the wife, the new wife, right, because that makes it a little more contestable, right? The new wife gets the money and my kids are excluded. She does not have to give them any of it. So let's think about that, right? These are very different laws on what oversees how a beneficiary form is looked at. So have you been divorced? Have you gotten remarried? Have you reviewed your beneficiary forms? You should, and we can help. And here's the last but not least section that we're going to cover today. Required minimum distribution aggregation mistakes. Now that is a mouthful, but I assure you it's not as confusing as that seems it's going to be. So let's think about what is a required minimum distribution. We've touched on it already, but at age 70 and a half, you must start taking money out of your IRA account, right? So if you got an IRA, a SEP IRA, a simple IRA, or some type of company-sponsored retirement plan, a 401k, a 403b, you have to start pulling money out of it when you reach age 70 and a half. Not the case with the Roth, remember. But any of these other types of accounts, you have to start taking money out at 70 and a half. Well, let's think about this. How do you calculate that? How much money do I actually have to take out? So we, fortunately for you, do all of this for you. So you never have to kind of go into the, find the IRS uniform life expectancy table, find the corresponding life expectancy that goes along with your age, and then divide your previous year-end balance by that factor to come up with your required minimum distribution, and then kind of hope your math is correct. We take care of that all for you, but if you're looking at $1 million IRA and you're age 70, you can see on that screen that your distribution factor there is 27.4. So essentially what you're going to do is take that $1 million and you're going to divide that factor into it, and you're going to come up with a number somewhere north of $36,000 that you need to take out as a required minimum distribution. Well, if you forget to do that, it's a 50% penalty. That's why we like to automate it for our clients. We like to send money directly to their bank, monthly, quarterly, annually, however they want to receive it. A lot of people like to, in retirement, feel like they're still receiving a paycheck, so a lot of people like to have it monthly. It can go any way that you choose. If you don't want the money, you don't have to spend the money. You just have to take the money. So for a lot of our clients, I would say well over 50% of our clients, we just move it over to their investment account. So we'll calculate it, we'll automate it, we'll take all that risk off of your shoulders so that you don't have to worry about it. Because you got to remember to go to this every year if you're going to do it on your own and distribute those funds. So rely on us for not only the calculation, but the distribution strategy as well. So if you think about it, a lot of people have a lot of IRAs, right? Maybe I've got 2 or 3 IRAs, one over here, one over there, and I have required minimum distributions because I'm over 70 on all of them. Well, how many accounts do I have to take them from? Well, with traditional IRAs, you can calculate the required minimum distributions of each of those 3 accounts and just add them up and take them all from one. You can take a little bit from each. It doesn't matter. You can aggregate them if they're of all the same account type. So if you've got 3 IRAs, you can take them all from one, or like I said, a little bit from each. If you have an inherited IRA account and a traditional IRA account, those cannot be combined as to one. Remember, it's a different set of rules for inherited IRA accounts. Now, additionally, if you have employer-sponsored plans, right, you've got this old 401k still sitting there. Maybe a lot of us have worked with a couple of different companies, right? Maybe I worked at ABC firm for 20 years and XYZ firm for 15 years, right? Now I've got these 2 401ks that are still floating out there in the stratosphere. I don't know what's in them, and I don't know how they're invested, but they're out there. Well, I need to take money out of both of those once I reach 70 and a half. I cannot aggregate across those accounts, right? So the way I can just lump them all together from one IRA, I cannot do that from a 401k. I need to take my actual distribution amount from each of those accounts individually. What we suggest most people do anyway is to roll those funds over into an IRA. It gives you control back of how you invest, right? Because remember, if your money's with a company-sponsored 401k plan or 403b plan, you are beholden to whatever the investment options are within that. And outside of that, you can do whatever you like with the money from an investment strategy. So we like to see people roll those funds over. And if they're all rolled over, maybe you've got an IRA and those 2 401ks, you can put both of those 401k plans into your existing IRA and only have to take one required minimum distribution. So just remember that you can't combine IRAs and 401ks and inherited IRAs and just take one and think that, okay, I'm all set. I've taken all this money from one account. You can't aggregate across multiple types of accounts. So, just be aware of that. And obviously, we like to be the ones directing those required minimum distributions because we don't want to see anybody get whacked with a 50% penalty. It's such a severe number. that if possible, you should do everything in your power to automate this and to take that risk off of your plate. So, we touched on a lot of these things and how we work with you. And obviously, we want to make sure that all your beneficiary forms are up to date. We want to make sure that we've done proper required minimum distribution planning, that we've got an income strategy as well, that we've properly aligned what types of accounts you should be using. Remember, we talked about the benefits of a Roth IRA and a traditional IRA. Which one should you be using? Should you be using a Roth 401k option at your employer? Which one gives you the most bang for your buck now and over the course of your full retirement plan? So a lot of the things that we're talking about today are maybe components of a larger overall plan that you think, well, I think of them just as the investment firm. Let's kind of remove ourselves from that mindset and remember that we're a financial planning firm first, and these are the types of things we like to talk about. So we're going to help you understand the impact of any of these types of distributions, contributions, beneficiary changes, their impact on your overall strategy. So I guess when any of these things come up, we hope to be your first source of like, I think I should go ask Jason or the folks over at Apella and Symmetry Partners for their advice on what to do with this, because I remember everything he said, but I do remember there was a lot of risks and a lot of penalties out there. So let's keep that in mind, and obviously never hesitate to pick up the phone and ask us any question. We're happy to answer anything that you have. And speaking of questions, I'll pause here for a moment and wait for any questions to be typed into the box. If something pops into your head after we sign off of this webinar, feel free to shoot me an email separately. Like I said, we're going to be recording this webinar, maybe the 6 o'clock or maybe a different one altogether. We'll be posting it to our website. So any of this information that we talked about today, you can certainly review again, but we'd be happy to talk to you about any of these topics at any time in the future. So like I said, I'll give you one more second here to type away some questions, and I'll just sit here silently. One of the things that actually did come up was the contribution limits for IRAs, and I gave the range for full deductibility at $61,000 for somebody single, and $98,000 for somebody filing jointly. There are ranges where you can make a partially deductible contribution as well. So that wasn't the end-all, be-all number. So if you make between $71,000 and $61,000, a portion of your IRA contribution can be deductible. And if you're married filing jointly, between $98,000 and $118,000, a portion of your contribution to an IRA could be deductible. But remember, you can make a contribution regardless of how deductible it is or not. But these are the ranges that are important to understand. So if you're single, between $61,000 and $71,000, you can make a contribution and have it be partially to fully deductible. If you make more than $71,000, none of it will be. And if you make between $98,000 and $118,000 married filing jointly, portion of that or all of it could be deductible, but if you make more than $118,000, a deduction will not be eligible. So that was one question that popped up here. So I don't see any others popping in at this time. I know we touched on a lot of material, so like I said, feel free to reach out to us with any additional questions you have. I really do appreciate you signing on here during your lunch breaks and taking some time to hang in there and learn about IRA mistakes. Stay tuned for more of these webinars in the future. If you have suggestions on any additional topics that you'd like to see, you can also submit those to us as well via email. One more time, thank you again for attending, and hope to talk to you all very, very soon. Thanks.